Good morning, good afternoon, good evening from wherever you're watching me from. Welcome back to our channel, everybody. Today, we are going to look at risk management. Risk management is one of the most important aspects of trading. And without risk management, you are never ever going to be profitable. Guys, get me right. You are never ever going to be profitable if you don't know risk management. It's one of the most important components of trading. In trading, there are three aspects. You need a good strategy. That is one aspect. You need good risk management, and then you need good psychology, your trader mindset as a trader. So these are the three main aspects of trading: good strategy, good risk reward management, and good trading psychology. The strategy can be anything. It can be Bollinger Band strategy, it can be super trend strategy, it can be support and resistance strategy, it can be demand and supply strategy, it can be price action strategy, or any strategy you've learned from anywhere. That accounts for only 10% of your success as a trader. Majority of your success as a trader depends on risk management and trading psychology. So your entry rules, your exit rules, your position sizing, they are all based on your strategy. But when it comes to risk management, this is when we do all the components. This is where we put all the engines together. All the engine of the framework of your trading appears under risk management. So if you don't know risk management, or if you have no idea of risk management, and you are always searching for strategies and setups and strategies and Fibonacci strategies and 5-minute scalping strategies, you will never ever become profitable. So pay attention to this video, take your pen and paper and copy everything you're going to cover in this particular lesson, okay? Because this is going to be one of the most important aspects of your trading career. Risk management entails 5 major areas, okay? Trading capital, your trading capital, risk per trade, risk reward, position sizing, and your exposure. These are the 5 major areas of risk management. So you're going to go through these factors one by one, and after this particular video, you'll be able to understand the concept of risk management. You're going to manage your risk very well so that you also become a very profitable trader. So talking of trading capital, the first question every trader asks him or herself is that how much capital do I need to trade this particular market? How much capital do I need to trade Forex? How much capital do I need to trade stocks? If you're into Forex, you can start with as low as $100 or $200 or $500, okay? But ideally, I advise start with $1,000 or $2,000. That is ideally. But if you don't have anything, you can start with $100 or $200 or maybe $500. But before you deposit any money into your trading capital, it should be amount of money you are willing to lose. Okay, so let's assume that you don't have anything in your bank account. All you have in your bank account is $5,000. You have just $5,000 in your bank account, and you want to deposit all this $5,000 into your trading account because you want to double it. Guys, you are going to lose it. I'm telling you, for the rule of thumb, for the facts, I'm telling you are going to lose this $5,000 because as a beginner, you are definitely going to blow your account. So if you have just $5,000 in your account, and people has lied to you that you are going to use that money to invest, people think Forex trading is investment. I've always been saying it. Forex trading is not investment. Forex trading is a business. Business, what do? You buy and sell. You buy and sell and take your profits out. That's all, very simple. So Forex trading is not an investment. So if somebody come and lie to you, there is an investment in Forex. Deposit 5,000, the next month is going to double. Deposit 10,000, the next month is going to double, or the next day is going to reach $100 million. Guys, run away from that person because trading is a business, which means you must wake up in the morning, you scan the market, search for which currency you are going to buy or sell, and when you make profit out of this particular currency, then you deposit it in your account. It becomes part of your margin. That's all. Like the way people buy and sell clothes, people buy and sell tomatoes, people buy and sell shoes, people buy and sell coffee cups, people buy and sell computers. The same way people buy and sell currencies. So in trading, it is a business. It is not an investment. You are not going to put $5,000 in your account and then it will double the next day. No, it is not an investment where you put in the money and then you forget about it and it will grow. No. So before you deposit any money in your account, think of it. Is it money you are having? Are you willing to lose that amount of money? Is it the only money you have in your trading account? If you have $5,000 in your bank account, if you have $5,000 in your bank account, then I advise you deposit just $1,000 in your trading account. That's all, simple. $1,000, or if not, even $500. Okay, if you have just $5,000 in your bank account, do not risk all because you might lose it. Only risk what you are willing to lose. Okay. So if you have, let's say you have just $10,000 in your trading account, $10,000, then how much do you think you can risk? I can advise you to risk maybe $1,000, same $1,000, or something like maybe maximum 2,000. Okay. Don't risk more than $2,000 on a trading account if you're a beginner. Okay, even if you're a professional, even me, I will never deposit my whole money in my trading account because trading can be very, 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 very dangerous. One mistake you make and all your capital is gone. So as a professional trader, I have about 5 accounts. I have 5 accounts with different brokers and I trade them with different strategies. So which means I don't put all my eggs in one basket. That's number one. Number two, you are not supposed to deposit your whole life and money into trading because you are likely to lose it if you don't know what you're doing. So the capital you're going to deposit in your trading account, you have to manage it to make sure that you are taking only maybe 5% of your capital or 10% of your capital that you have in your bank account into your trading account. Okay, you're not depositing your whole life savings into your trading account. Don't put your food and money, don't put your rent money, don't put your school fees, don't put your pension pay into trading account. Maybe you are a grown-up and you have pension. Okay, you go to the social security and you take your pension allowance and you deposit all in trading account because somebody has lied to you that you can double it. Guys, it's not going to work that way. You're going to blow it and your life is going to be very miserable. Okay, you're going to be very miserable. So please listen to my advice. In traditional businesses, you know that when you are buying and selling goods, let's assume you are buying and selling cars, you are buying and selling estate, apartments, you are buying and selling computers, you are buying and selling clothes or whatever. If you buy any of these things, they don't buy, the public do not buy, or they don't consume your goods are still there, right? They're physically, they are still there. But in trading, the least mistake you make, you will lose your whole capital and then you are out of the market. You lose your whole capital and you're out of the market. The least mistake you make. So be careful, be careful. How much capital you have to deposit in your account depends on how much you have in your bank account. Deposit something small you are willing to lose. Okay, if you're a student or if you're a newbie or you're a young guy, deposit something like $200, $500, and just start trading with it. Okay, don't go and borrow money from your friends. Don't borrow money from your friends. Don't borrow money from your parents. Don't borrow money from a bank to come and trade, guys. Don't let anyone lie to you. The capital you're going to use to trade must be something you can afford to lose so that in the event where you can lose it, it does not become a burden on your life. You do not risk your whole life. Guys, do you get it? The next aspect of risk management is risk per trade. Risk per trade is the amount of capital, amount of your trading capital you are willing to lose. So let's say that you have $10,000 in your account, in your bank account. You decide to deposit 1,000 of this particular amount in your trading account. So this one becomes your trading capital. Now, how much of these 1,000 are you willing to lose? Are you willing to risk per trade? Guys, I'm not saying that deposit 1,000 into your trading account and use all to trade. No. The 1,000 you have deposited from your bank account or your whole life savings is to be deposited in your trading account. So this trading account, now you have 1,000 in your trading account, right? You have $1,000 in your trading account. Are you going to use all the $1,000 to trade, guys? You can't use all the $1,000 to trade. So when I say risk per trade, is how much of your trading capital you are willing to risk per a single trade. So let's say this is trading capital. Let's make it trading capital. So now on our trading capital, if you have $1,000 in our trading account, how much are you willing to lose? Ideally, you are supposed to lose 1%, 2%, 3%, or maximum 5% of your trading capital. What does it mean? It means that if you have $1,000 and you're risking 1%, I think 1% of $1,000 would be like $10 or $20. Guys, calculate it, let's move on. So let's assume that you are risking $20 per trade. Okay, which means any trade you're going to take, you're not risking more than $20, which means when you lose $20, and when you win, you're going to win something more. We'll come back to risk reward later, okay? So you're risking $20 per trade, which is per every single trade. Let's say that your capital is very small, $1,000, and you can't risk $20. It's very small because to make profit out of $20, it will take you years, okay? So let's say that you decide to break the risk reward rule and decide to go a little further. So you decide to risk maybe 5%, which means at least you must risk maximum of $50. $50 of your capital on a single trade, which means when you win, you are going to win something more, which we come back to the risk reward, okay? And when you lose, you must always lose just $50 or $20 or maximum, maximum. If you want to break this rule, then you must just risk $100. You must just risk $100 on your trading capital. never risk more than $100 on a trading capital, which means if you risk $100 on a trading capital, you can take only 10 trades with $1,000, guys. Can you hear? You can take only 10 trades. That's why it's advisable not to risk something bigger, okay? Because if you risk $50, then you can take about 20 trades, right? Before your $10 gets blown. So risk reward is a very risk management is a very solving component of profitable trading. If you don't know risk management, you will never ever in your life become profitable trader. I'm telling you, and I can bet on that. So after you've decided your trading capital and how much you're going to also risk per a trade, then the next important component of risk management is risk reward ratio. And what is risk reward ratio? Risk reward ratio is how much you are willing to lose to make in advance. So for instance, if you are willing to lose $50, then your risk reward ratio can be you lose $50, to make $100, which is risk reward of 1:2. Very simple. If you are risking $100 on a trade per your capital, which means that you risk $100 to make $200, which is risk reward of what? 1:2. The same risk reward of 1:2. Some people prefer to risk 1 to make 3, which means that if you are risking $50, and you want to make something more than $50, more than 1:2, then risk $50 to make what? Maybe $150, which is 1:3. Very simple, guys. But ideally, I advise you always risk 1 to make 2, okay? Because the market can be very erratic. Sometimes you can also take something less. 1:2 is the max. I always tell my students, risk 1 to make 2. Very simple calculation, and you are free. You are gone, guys. If you risk $100, make sure you always make $200. If you risk $200, make sure you always make $400. If your capital is big and you can risk $500, make sure you always make what? Yes, $500. The ratio is what? $1,000. Very simple, guys. So risk reward is also a very good component to become a successful trader. If you don't manage your risk reward well, you will never become profitable trader. Let me give you a scenario here. Let me clean this thing, guys. Assuming you take 30 trades in a month, okay? So 30 trades in a month. I'm writing the amounts, guys, so just bear with me, okay? It's very hard to write the amounts. 30 trades in a month, and out of the 30 trades, we have 15 wins and we have 15 losses. With risk reward, this is wins and this is losses. With risk reward of 1:2, you're definitely going to become profitable, right? Because if you are risking 100, you're going to make 200, which means assuming you are risking $100 for easy calculation, let me use $100. So those with smaller accounts can also bear with us, okay? If your account is bigger and you can raise $1,000, fine. The same calculation, just add zeros, okay? So we have 15 wins and we have 15 losses. So we are risking $100 per loss times 15, right? And you are making $200 on your return times 15. So guys, if you do the calculation, won't you become profitable? Yes, you can become profitable, right? If you do the calculation and you did that, let's say 115, you're going to get 1,500, right? Am I right, guys? I don't have calculator here, so I'm just teaching you. So you're going to get something like 1,500. 250, you're going to get 3,000. 3,000. I'm just giving you a scenario at the end of the month, okay? Then what do? You deduct. When you deduct your losses from your wins, you definitely become profitable. So you're going to get profit of extra 1,500, which is $1,500, guys. Very simple. With risk reward of 1:2. So always your risk reward must be 1:2 or more. Okay, you can take less, but unless you know what you're doing, if you take less, which means your win rate must match with your risk reward. But today we are not talking about win rate, we're not talking about strategy, we're talking about risk management. So you can either risk 1 to make 2, 1 to make 3, okay, or 1 to make 1.5. Don't go that far. Don't risk 1 to make 6, guys. I'm not fan of that. I'm fan of simple trading strategy. Simple. You risk 1, you make 2, you're out of the market. Set for that trade, you risk 1, you make 2, you're out of the market. Okay. So risk reward is how much you win per how much you lose. The next important component of risk management is position sizing. What is position sizing? Position sizing is the amount of the currency you are buying. For instance, you can buy 0.001 This is the minimum you can buy, right? Somebody can buy 0.002, 0.003, which means if you're buying this, you'll be risking something like $5, $10. Forget about that. Pay the pips, okay? But ideally, if your account is a little bigger, maybe you can buy 0.1. Okay, if you want to risk something like $100 or $50, can buy 0.1. 0.05 is not bad for a small trader. If you're a big trader with huge capital, then you can buy 0.1, 0.2, 0.3. Okay. Oh, this is funny. Good. 0.3. It depends on it depends on how much you want to risk on your capital. So your position sizing per how much you're going to buy per the currency should match with your risk per trade. How much you are risking. Okay, it should match. If it doesn't match, and then you're going to have a losing trade, your account will be blown. That's why people just enter the forex market within 1 month or 1 day, sometimes even 1 minute, they lose their whole fortune because they entered the wrong position sizing and it went against them and they lost their whole money, guys. So be very careful with position sizing. Practice this on a demo account. Buy and sell with the same position sizing to see how much you are losing or how much you're winning. Okay, before you practice it with the raw money, you know that okay, anytime I buy 0.1, I'm losing this amount of capital on my trading capital. I'm losing this amount on my trading capital. So for instance, if you're taking 10 pips per your strategy, maybe you're taking 10 pips per your strategy, which means that if you risk 0.1, if you buy 0.1, how much are you risking? Okay, if you buy 0.1, how much are you risking? Test it on a demo account before you enter the market to buy or sell. Do you understand? Test it on a demo account. So your risk, your position sizing should be very carefully calculated. If not, you are going to lose. So test it on demo account. Buy 0.2, buy 0.05, buy 0.6, buy 1.0. Buy anything, okay, on demo account to test it to see how much you are actually risking in live account before you start trading live accounts. Guys, do you understand? So position sizing can whipsaw your account, guys. The next important component of risk management is your maximum exposure. And what is maximum exposure? Before we move on, guys, if you have not subscribed to the channel or if not liked this video, please do so. Subscribe and like the video, okay, and hit the bell icon so that anytime I upload video, you'll be able to get update, okay. So maximum exposure. Oh, my people are in the house. My people are in the house, guys. Okay, guys, I'm back. Bear with my background noise, okay. My family is in the house, and today is actually a free day for them, and my family is in the house, so they are making noise. Just bear with me, okay. Listen to what I'm trying to teach you here. So the next factor is your maximum exposure. Maximum exposure is how much you are risking per particular trade. For instance, assuming that you are risking $100 on every trade, right? And then in a day, you've taken 3 trades, guys. You've taken 3 trades, which means 100, 100, 100, 100, guys. If you do that, what will happen? It means you are exposing $300 of your account. Do you understand? You're exposing $300 of your account, which means that you don't have to take simultaneously these trades simultaneously. Don't take 3 trades simultaneously. Make sure that you take 1 trade, and when 1 trade is about to be executed, you take another one. If you take 3 trades simultaneously, which means you are risking $300 of your trading capital on that particular moment. That's maximum exposure. Don't expose yourself too much, okay? Maximum, if you want to take trades continuously, like simultaneously, take only 2 trades, at least 100, another 100, and then at least when there's news on the market goes against you, you don't lose more, you lose only few, okay? So the maximum exposure can also make you profitable or can make you a loser, because if you take 3 positions at a time and then market goes against you, all the 3 positions can be affected, and then you lose about 30% of your capital. Meanwhile, you're not supposed to lose 30% of your capital. You're supposed to lose something small, maximum 5% or 10%. But because you are exposing yourself too much, trading this, taking this forex pair, taking another forex pair at the same time, the market can whipsaw your account. So please be careful. Maximum exposure is very important. So let's recap. Risk management is a very important component of successful trading, right? And we know that before you can trade successfully, you must have what? Trading capital. And trading capital should not be something that you are taking from your hard-earned money, okay? Don't just go and deposit all the money in your bank into your trading account. Guys, you can blow it. So for a rule of thumb, make sure you deposit something small that you can afford to lose, maybe 5% of your whole bank account or 10% of your whole bank account, okay? The next important component is what? Your risk per trade. So after you deposited some money in your trading account, that maybe you deposited 1,000, or you deposited 10,000 and decide to risk $50 or $100 or $20 per trade, then make sure that you are risking only those amounts. You don't change it, okay? Don't say today I'm feeling happy, I want to risk $50. The next day I'm feeling sad, I want to risk $20. The next day I'm very confident, let me risk $100. Guys, if you do that, you are going to mess the statistics up. You're never going to be profitable. So if you decide to choose, okay, I'm risking $100 for this whole month, make sure that you're always risking $100 for the whole month, okay? I'm risking $20 for the whole month. You're risking $20 for the whole month. You don't change it, okay? You don't change it until you have enough samples to you take your profit out of the market and then you restart again. Okay, so you always aim to take at least 30 to 20 trades, 20 to 30 trades, or it can even be more, but at least aim to get half of them to be correct and half of them to be losses, and you can definitely become profitable. Also, check your position sizing. Your position sizing must be accurate. It must match with your risk reward or how much you are risking per trade. Okay, your position sizing must match. Practice on demo account. Buy and sell for free demo account and use it to test how much you are willing to risk per your capital. If it matches, then you choose that particular position size and then you use that one as your entry position size. Very simple. Then your exposure, do not take more than 2 trades at a time. Okay, maybe if you want to take more than 2, if you want to take more than 1 trade, it might be 2, maximum 2. Maybe you take first trade, then you take second trade. That's why you wait when these trades are closed, then you can take another one. Don't take more than 2 because you can risk huge capital, huge part of your capital. These are some of the components that make you a successful trader. So if you have listened to me and you've taken some notes, it's up to you now to sit down and review all what you've said. Okay, this is very, very simple. Review all what you've learned today, and I hope that you're going to just practice. Okay, practice this thing. This is just simple math calculation, guys. Do them yourself. Practice them, practice them, practice them, practice them, and you definitely become profitable. This is Seth Owas, your trainer for this entire series. Like and subscribe to my channel, and hope to see you next time. Come back every time and watch this kind of videos. Bye.